Hello students. Today we would be discussing about foreign exchange risk management through derivative instruments. In this module, we would be concentrating mainly to currency risk management through currency derivatives. Now, can you guess what would be the underlying assets in case of a currency derivative? Yes, I hope you guessed it right. The underlying asset in a currency derivative would be currency. Now, what is this all about, or why do we need currency derivative instrument? The basic idea behind a currency derivative instrument is to hedge against the exchange rate fluctuations, that is, foreign exchange rate fluctuations in the value of the currency. Now, you know that there are many factors that will affect the price movement of a particular currency. It is not limited to a particular country in a global scenario. Right. We'll start with first, what is an exchange rate? Exchange rate is the rate at which currency of one country is exchanged with currency of another country. This is an example. We just express like this: €1 is equal to 83.26 Indian rupee. This is when we are planning to exchange currency of one country with another country, we need to know what is the value of our currency in terms of the other currency which we are planning to exchange, right? And there the importance lie in hedging a risk or protecting against the fluctuation in currency rate. That's where we talk about currency risk management. Let's go further. There are basically three types of exchange rate system. One is clean or independent floating exchange rate system. Two, pegged exchange rate system. And three is managed floating exchange rate system, which we follow in India. Right? Now we will take one by one. Clean or independent floating exchange rate system is a system where the market forces come into action. Here, the exchange rate is decided by the forces of demand and supply. So it is very flexible. It is a flexible rate system which would be moving according to the market conditions. And what you have to remember in this is the government intervention in this category of exchange rate system is totally nil. There is no government control. It's fully left to the market and determined by the demand and supply of each currency. Suppose if the demand is high and the supply is low, naturally the value of that currency will go up. Right? I hope you understood that. It's very simple. Now we will take the second one. The second one is pegged exchange rate system. Now the word pegged itself indicates what is this exchange rate system. The nature of this is it is very much fixed. It's otherwise called as fixed exchange rate system. Here, this currency is fixed or pegged by a monetary authority in the country against the value of another currency or maybe any other means like gold or any valuable metal. So the nutshell which you have to understand is it is pegged. It is pegged to or it is pegged against the value of another currency or maybe another precious metal. See, if I tell an example of this, we all know that the Hong Kong dollar, it has been pegged to US dollar. It is required to keep the currency trading within 7.75 and 7.85 to the US dollar. If there is any change in this, if it has come to the upper level or the lower level, immediately the monetary authority come into play and they ensure that it stays within the targeted band. So in short, a pegged exchange rate system is a system in which one currency is attached, is pegged to another currency or another metal or precious stone, normally gold, right? Okay, I hope you understood that. Now let's go to the next one. The next one is manage floating exchange rate system. I hope you know this because in India, we are almost following this exchange rate system. It's otherwise called as crawling peg, crawling peg. Here, the particular feature of this system is it fluctuates on a daily basis. There is no control. It is controlled by the market force, demand and supply. But there is a certain range which is always maintained. So it's not fully free as the first case. Here, the central banks, they try to influence the value of the currency. They try to maintain the value of the currency if it is going a particular, if it is going beyond a particular level. So in India, we follow this exchange rate system from 1994 onwards. I repeat, this in the managed floating exchange rate system, the exchange rate fluctuates from day to day. But central banks attempt to influence their country's exchange rates by buying and selling currencies to maintain a certain range. Now, do you have any doubt with the previous one where we said pegged exchange rate system and this one? Here, what you have to understand is the currency is not, that is in case of managed floating exchange rate system, the currency is not pegged to any other currency. It is left to play in the market depending on the demand and supply. But ultimately, when there is a severe change, it is because of the market conditions, then the central banks attempt to influence their country's exchange rate by taking necessary actions. These necessary actions can be pumping in money or pulling out some monies or maybe minimizing the money supply in the market. I hope you are there with me, right? So we talked about three types of exchange rate system, that is clean or independent floating exchange rate system, which is very flexible. Second one is pegged exchange rate system. And the third one is managed floating exchange rate system. Okay, now we will talk about exchange rate quotations. First, let's talk about what is this exchange rate quotation. Exchange rate quotation is a statement showing willingness to buy or sell foreign currency at an announced rate. So it is a statement expressing the willingness either to buy or to sell a foreign currency at a predetermined rate. That's why we said it's an announced rate. There are two ways of putting this quotation. One is direct and the second one is indirect. Now we will see what are these. Direct quotation. It's otherwise called as price quotation or European terms. Here, the key or the important factor which you have to remember is the foreign currency is expressed in terms of domestic currency. So, direct quotation is when one unit of foreign currency is expressed in terms of domestic currency. I have put an example here. You can see I put an example where one US dollar is equivalent to 76.60 Indian rupee. So here, 1 unit of foreign currency is expressed in terms of domestic currency. I hope that's clear. Okay, now we will look at the second one, that is indirect quotation. It's otherwise called as quantity quotation or American quotation. What you have to understand is it is just the reverse of direct quotation. Here, 1 unit of domestic currency is expressed in terms of foreign currency. Look at the example. 1 Indian rupee is equal to 0.013 US dollar. But I think normally we have seen direct quotations, right? We normally express 1 unit of dollar is equal to 76.60. When it is expressed in the reverse way, that is what we call as American terms or quantity quotation. Is that clear? I take it as yes, because it's very simple. Now we will go to the last part of this module where we are talking about bid. Okay? Bid and offer rate, also called as bid price and ask price. Now, what is a bid? A bid is the highest price which a bidder is ready to pay for buying another currency. So, it is the highest price which a bidder is ready to pay while he is purchasing another currency. If that is the case, what is ask or offer price? It is the price at which a dealer will sell the other currency. So it's just the other part. It's the opposite part. Yeah. So normally a dealer buy at the bid price and sell at the ask price. When we logically think it should happen in that way only, right? So this is all about bid and offer rates. So I conclude, why did we discuss about currency derivative in foreign exchange management? Because currency derivative is an instrument which help to hedge the risk against currency rate fluctuations or foreign exchange rate fluctuations. Thank you, learners. See you in the next video.